Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The last few days, we hearing a lot of voices and sane voices, and maybe they are right, about the fact that there are imminent risks on the horizon. And what US President Joe Biden might do with regards to corporate taxes may only add to the volatility. However, in all of this, while recognizing the fact that there are risks on the horizon, Ganeshram Jayaraman of Spark Capital believes that the risks to missing out on the recovery may be higher than the risks on the horizon from an investment portfolio perspective. It's an interesting thought. Let's try and debate this with him and get him on the show to talk about this. Ganeshram, so good having you. Thanks much for joining in. Hope all is safe in Chennai. I can tell you Bombay is a bit of a pot boiler right now.
Hi, Neeraj. Morning. Things are definitely better in Chennai. Let's hope it continues this way.
Yeah, let's hope it stays
Let's
across.
hope Mumbai recovers fast for the sake of all of us.
Yeah. Yes, I knew you would say that. I was just preempting what you were going to say. We just hope that it's not just Indian borders, but world over, this thing passes over soon. But Ganeshram, let's try and drive that, and then the first point, and then I'll come to your portfolio strategy, which has evolved as well, and how is it right now. But I found that that line in the mail that you sent me fairly intriguing, in that sense that you are saying that while there are imminent risks on the horizon and there are various forms of them, the risk to missing out on the recovery may be higher. Why do you say that?
See, at the core of this whole thing is, if you step back and watch why the whole cyclical recovery hypothesis of us has been built now. It's now pretty much 12 months, pretty much from the same week last year onwards, we've been saying this. If you step back and see the reasons why we kept highlighting these points, look at the money lying on the sidelines, waiting for it to get converted into demand. I'm talking here of the real economy. Okay, it's unprecedented that in a shrinking economy, the savings bank balances expand in any economy, but it's expanded in India, which is actually, and it's expanded in absolute terms by the highest quantum ever seen. And it tells you a certain puts in perspective in terms of how much of it can get triggered into consumption. And mind you, the quantums we're talking is very, very large. We're talking here of in excess of about 6 trillion rupees of savings bank balances accretion during the pandemic. And we all thought pay cuts and job cuts. But the cumulative bank balances which banks are reporting of savings bank balances tell a different story. That's point one of the whole the money lying on the sidelines. Now, second point, which is even bigger.
Sorry. Can you elaborate a bit on point one, and then I'll come to point two? What is the point that you're trying to make? Are you saying that people are sitting on cash, waiting for an opportune time, either mentally or sentimentally, to deploy that money?
Precisely, right? So the accumulated savings, okay, is enough for it to start triggering or getting catalyzed into consumption, which is the whole point for us. That's an important variable we need to keep it in mind, that the ability to afford the down payment of, say, a house or a car or a durable or whatever suits anyone's budget, that ability to afford it has actually expanded. The bank balances are reflecting a story.
That's interesting. And Ganesh, I'm sorry, I'm just dwelling on this point a bit before we get to point number two. But I would have thought that the last 12 months, maybe 75% or 80% of the population would have seen some bit of wealth destruction, right? Because either jobs would have been lost or salaries would have been cut, and whatever consumption had happened, and frankly, for maybe 75, I'm just using this numbers arbitrarily, but maybe for 75% of the populace, there is no difference between discretionary and non-discretionary. All the money that they have gets used for daily consumption. And if there is a wealth destruction there, then a large percent of the population has actually not seen savings accretion. So do you reckon that the consumption uptick that can come in via the savings account balance that you're talking about can happen with the 15-20% of the populace?
See, precise numbers, 15, 20, or is it 30, 40, 50, we don't know. I'm looking at collective numbers. I'm saying that how is it logically right. See, we all look at it and say, hey, I'm spending less on eating out, I'm traveling less, so logically my balances have increased. That's not the right way to see, because my expenditure is income for somebody else. And if I'm looking at collective savings bank balances, which have expanded close to 6 lakh crores during the pandemic, and that's the point
Okay.
which means the ability for that to get consumed, for it to be triggered into demand, is a very important point. But this is not just the only point. There is a second point which I was starting, which is about the look at the bank's balance sheet. For the first time since I think 2003, the excess statutory liquidity ratio, which basically the bonds, government bonds lying in in banks' balance sheet, the excess SLR, as we call it, is close to 18 lakh crores. It's almost 12% of the total liabilities. What, in other words, what it means is the deposits have come. Banks haven't lent it on either to working capital or for retail loans. Instead, they've gone ahead and bought bonds, and they are sitting ready. When the demand recovery starts, the trigger for it to get converted into either a corporate loan or a retail loan is very high. And if you go back to 2003, this is what happened then. SLR requirement was in excess of 40% at that stage. The credit to deposit ratio was 50% in the system. And when until then, banks didn't have the ability to fund government borrowing, which is the bonds, corporate borrowing, and retail. Banks didn't have enough money to fund all three. And that's the reason you found retail loans didn't pick up then. And when the SLR requirements came down, banks could start giving out retail loans, and that led to, till then, retail loans were very, very small in banks balance sheet. The trigger for retail loans picking up was the big shift in banks balance sheet and the excess SLR which came about then, which is actually what we are sitting in even at this point in time. Apart from the fact that banks are parking, till maybe 15 days back, they were parking about 6 to 7 lakh crores, 6 to 7 trillion rupees in the excess reverse repo window reserve bank. Quarter end, year end, advance tax, so that number has gone down a bit, but generally it goes back again as things normalize. So which is the second point, the excess money lying waiting for it to be deployed is in excess of 23 lakh crores. Assume at any point in time banks will sit on, say, 3-4 lakh crores of excess SLR as a buffer. Even otherwise, you're talking here of 20 trillion rupees, which is very large sum of money waiting for it to be deployed. Now the question comes back to, where does this money come from? Okay, it's a combination of various things. India during the pandemic has received $120 billion of money from net inflows from somebody outside India. It is in the form of lesser Chinese imports, more FDI, more FPI flows. There are actually 10 reasons. Our exports have fallen lesser than our imports. So it's a combination of so many variables. IT is held up, remittances from NRIs have actually held up. So the reasons are many. But the broader point is, India is a net recipient of $120 billion worth money. That in itself is 9 lakh crores. This is just during the pandemic. And that's what is inevitably found into somebody's bank account. It could be a corporate or a government's accounts, or it could be in retail consumers' bank accounts. So put the three together, the money waiting for it to be triggered into consumption or into capex of some form is actually very large. We have not sat on so much shock absorbers, buffers as we are sitting today. Another variable which we all know but we ignore, Neeraj, which is you see, the last 12 months has been possibly the first time, at least in my knowledge, first time where equities, bonds, property, and gold have given positive return. Okay, and if you had asked the central banks globally, including in India, same week last year, when the lot of coordinated central bank action was happening, what are you trying to achieve? They would have not have told, but they would have possibly played in their minds. Incomes or the income statements are going to be impacted. Let me strengthen your balance sheet. Okay, let me give you shock absorbers to absorb the pain likely to come. That's possibly what they would have anticipated, and that's played out precisely. And mind you, equities and bonds are held by a very small fraction of India, but gold and property are as democratic as you can ask for. And and uh, and and the wealth effect of that, you mentioned wealth effect. I'm saying the same thing. The wealth effect of all four asset classes having done well within a 12-month period has actually also maybe played as the mind's a shock absorber, that confidence factor, which is also something which we can't shrug it away. The impact is quite large, and those are the things which I look at in terms of the pool of money which can get translated into demand. Now the
So,
second, sorry, carry on.
no, no, please finish your point. Then I'll ask my question. No problem.
So the question really is, how does this get triggered into demand? Okay, so money can lie idle for long time. This has been idle for a while already. So what is the reason that can pick up? See, the reasons are many, but the crux of it is government is borrowing two times what it set out to borrow. Same for the same time last year to now. The government borrowing is almost 9 to 10 trillion rupees, vis-a-vis half of that budgeted for when the year began, which means they are tapping into this excess liquidity to spend it on infra, to spend it on rural demand or food procurement, or whichever way. But they are spending that, using that liquidity, tapping it, spending it, and getting that money back into people's pocket for demand revival. That's one way. The second approach is, second reason it's now getting triggered increasingly is household capital expenditure has become in the form of property or automobiles or consumer durables. Why are we seeing the impact of negative real interest rates? Now, consumers do not understand negative real interest rates, but they know to compare rental which they are paying vis-a-vis EMIs, the post-tax impact of both, and they know to compare EMIs as a percentage of income. And when both those are attractive, which is the implied effect of negative real interest rates, then it starts triggering them to make decisions on property or on anything to do with leveraged consumption, which we are again saying. Property was one of our key calls at the possibly what June. We started telling, what we think property, and mind you, we got a lot of pushbacks in June for telling, property will pick up, which had not picked up for 7 years, and we were the ones saying for 7 years that real estate is on a sharp down cycle, and suddenly in June we said the cycle is going to turn. The reasons were many, but this was one of it, and that's how the trigger into demand will happen. And eventually, mind you, this will go into corporates also spending on capex. We think that's at least 12-18 months away, but eventually that will get triggered as well. Negative real interest rates and corporate capex have a lot of things to go in tandem.
So actually, my question is this, right, Ganeshram? If indeed large oodles of money is waiting to be spent, and if it all comes out over a bunched up period of, let's say, 12 to 18 months, what could the impact on the markets be? Because sure, there will be spending, there will be consumption, and therefore the real economy will see growth, but it will be accompanied by inflation. And currently, inflation seems to be the boogie word. Inflation and rising yields could spook. I mean, we aren't seeing that in India, but if it happens globally, and if parallelly we start seeing signs of that in India, could a rising economy be negative for valuations for the markets at large?
Markets are clearly ahead of recovery by at least 6 months. Typically, they always are, and again today, markets are looking beyond COVID actually, and the vaccination trends are indicating that in the next 3 months, including March, maybe another 3 months. Say we are talking here of 120 odd days, exclude Sunday, so we are talking here of almost 2.5 million people vaccinated every day. So 100 days, you're talking here of 250 million, which is almost 80% of the adult urban population. And so I guess markets will be talking of an, at least in the urban India, some kind of herd immunity, at least one dose of the vaccination done, which means as we go past June, normalization. Now things can change. You never know if the vaccines are indeed going to play out exactly, and those question marks are there. None of us know the answers for that, but logically this should play out, and that's what markets are seeing. That's all. That's the base case expectation, that by come June, July, we should be in a far better state of herd immunity and normalization of activity, which means this points on demand, or normalcy in this money getting converted into demand should start playing out, which is our base case. Now you're talking inflation and the impact of bond yields. Now, early in a cycle, if you study how cycles of inflation have played out over the last 20 odd years, and even other countries over previous years, you realize that the first 12 months thereabouts of inflation is actually very good for equities, bad for bonds, but good for equities. It gives the much needed pricing power, it gives the much needed inflation to earnings. We have had a period of muted earnings because of low inflation or even deflation during periods. WPI was in negative territory for an extended period of time. So we have not seen earnings get boosted up by inflation. So initial periods of inflation are actually good for earnings. Now markets are ahead of it. So earnings will play catch up with markets. That doesn't mean markets will react again for earnings, because they're already ahead of it now. So normally we should see the initial periods of inflation pretty a conducive environment for earnings. Eventually it will come back to bite us, but our assessment is it's too early to call for it, at least in India. Globally it could be a little different. India's inflation dynamics are a little different in terms of its character. What I mean is, the food inflation is almost half the consumption basket and inflation basket as well. And there, the pandemic led abnormalities kind of took food inflation higher in calendar 20. Like, for example, exports of food grains in India went up 40 odd percent. Some countries, in fact, most countries, stocked up more than requirement. Nobody wanted a food shortage during a pandemic. So, and including India, our food grain stock went up very sharply. So all this meant food inflation went up. That should normalize. And given the weights, the non-food inflation going up, and with food inflation likely to moderate, our assessment is the overall inflation figures should be in that 5 to 5.1% range if we talk the next 12 months. Now, how that translates beyond the 12 months, we need to see how demand is. If demand is strong, inflation will be stronger. So that's a question we need to watch, how calibrated the kind of growth we end up having. But the broader point is, inflation is not necessarily bad for earnings. In fact, we actually think it's a tailwind.
No, it may not be bad for earnings. It may not be bad for earnings. I wonder if it still manages to spook the markets. I can understand the earnings trajectory is probably going to be very strong, but can inflationary expectations and the advent of a higher inflation spook markets? Right now, it's happening in the world. Could it happen in India? Is the question. You don't think so?
We don't think it's our base case, because our assessment is the food inflation moderating, keeping the overall CPI in check will lead to a stable central bank action or currency, or all the macro variables should be in check. And
Okay.
another point on the bond deals that you touched upon, right? See, bond deals are not just about US bond yields going up 100 basis points from the lows, so we should also go up 100. Doesn't necessarily play out like that. The bond yield differentials between, say, India and US, compared with the inflation differentials of India and US, those drive how at the margin bond yield differentials behave, or how the bond, the impact of this on currency or interest rate environment plays out. When we compare the differentials in inflation and bond yields, we don't see that to be a material risk. And also with all this inflation point I told you, we believe RBI will remain conducive to do open market operations, and that should also lead to a better, more stable macro. So when we weigh all of this, our base story is macro stability, and that means we are not going to get headaches from that front. So we as well focus more attention on earnings, margins, multiples, companies' strategies to see the recovery. So our broader point is it's going to be more bottom up market, because macro is not going to. Some things could change, but as we sit today on 31st March,
Largely benign.
our assessment is, having seen through potential risks, what all could play out and positives, our call is it's going to be a macro stability, which means attention is better off focused on earnings, margins, and multiples.
So let me ask you that question, because otherwise the earnings conversation can be very long. But let's try and focus this on a point that you mentioned earlier, that the markets have run ahead and earnings will play catch up. And therefore, I would presume that in certain pockets, because those pockets have run so far ahead of themselves, that an earnings uptick will not lead to any kind of positive surprises, right? And therefore, maybe the idea should be to look at pockets wherein the market is mispricing earnings or the market is mispricing valuations. Now, is that part the core part of your portfolio advice? And therefore, what is that part?
Yeah. Now let's step back and again, look at it. Why we think it's an earnings upgrade cycle? Earnings can surprise in the first phase of a cycle, because the construct as we see today is something that we have not seen for almost, or fiscal 4, calendar 3 was the nearest comparable. Even that is not a good comparable, because four things are coming at the same time in our assessment. That is, number one, demand recovery, as I told you. Number two is pricing power, or in other words, not just a volume growth driven recovery, it will also be pricing hikes led top line growth. So volume multiplied by value led impact on top lines. And why should that happen? There are a couple of points out there. Now, if you see the last 3 years, we have been seeing industry consolidation in almost every sector, except maybe a very few sectors. In banks, the top 6 banks, maybe 5 banks, have taken away close to 2/3 of the growth, incremental growth. The same way it's happening in housing finance, in cement, in steel, in aviation, in telecom, in real estate, passenger cars. You're possibly looking at it even in a general insurance setup, ports for sure, or even smaller sectors like, say, tiles, or electrical cables. So pretty much widespread. What's happening is the top few players are disproportionately gaining market share. Now, why is it very important? This is a very important reason in how we see pricing power play out. When demand recovers and inflation, recent commodity price inflation, happens simultaneously, consolidation will lead to pricing power, or consolidation will lead to industry pricing discipline, and that will lead to companies being able to take price hikes without letting demand suffer. So the 3 points coming together has happened for the first time since 2003. This happened then, and that led to year one of a cycle being very good for earnings. But this time we think markets are ahead. Now earnings will play catch up, but definitely earnings can surprise us on this front. There's a fourth angle, which wasn't the case even in 2003, which is the lockdown led impact on costs, operating costs management, or what companies have done during the last 12 months is the impact of they've been able to change or make structural changes to their cost structures. They have variabilized a lot of costs which were otherwise fixed in nature, and they've also been able to cut the flab quite substantially. So what it has done is, even in a normalcy scenario, our assessment is the costs can go back to where it was pre-COVID, but in as a percentage of top line, it will be far lesser. So which means operating leverage. And the key point in this whole thing, where say markets have already priced in demand recovery, markets have priced in the operating leverage. Where markets have not priced in is the impact of pricing power or price hikes and operating leverage put together. Those two have a very potent combination, when seen, in conjunction, the impact of all four variables: demand, pricing, consolidation, and costs, that's something that none of us have seen ever. For maybe for 20-25 years we've not seen something like this, and that's why we believe estimation error on earnings is quite high. And our assessment, when we do a sensitivity for companies, we believe that the operating leverage gets exaggerated during periods of price hikes. And that's where I went go back to the first point which you said, which is inflation is actually a tailwind, it's not a headwind. Eventually, if we do too much of it, if there is too much of, or if there is a sharp food inflation or wage inflation or too much of commodity inflation, which cannot be passed on, and if demand moderates a bit or if currency depreciates sharply, those variables might come back to hurt us. But though we don't see it for 12 months at least. That's where our whole Goldilocks phase of earnings expectation is yet to even start. Maybe it's got pushed out a bit more due to the spike in cases again, but we still hold on to that view.
So Ganeshram, let me ask you, you work with this thesis that the earnings approximation will, most people will err on the downside. My question to you is, if you are working with this hypothesis that the combination is very potent for a multiplier effect, in your estimates for your favorite companies that you understand the most, are you still being conservative because sell side rules kind of demand so? Are you still being conservative when you're putting out FY22 EPS estimates?
Definitely we will be, because we wouldn't want to be predicting when companies will take price hikes. So price hikes will be something where we'll be reacting to in terms of timing it. We wouldn't want to be too ahead of it. See, there is one more point in this whole thing which I should highlight to you. Okay, in the last maybe 7-8 years, India has seen misses on earnings almost every year. We expect EPS to be X, it ends up at 0.8x, but valuations look higher, right? Stocks haven't. We are coming off a phase where earnings growth was muted, but multiples were high. We think it's a reversal now. Our next few years expectation is earnings will get boosted up by inflation, and multiples, we are better off in our base case expectations to work with deflated multiples. So vis-a-vis, say, 5-year average price to earnings or price to book or EV EBITDA multiples, we will advise our clients to have a lesser, maybe 25%, 20% lesser exit multiple. That's sensible in our assessment. We don't think it will happen rationally simultaneously. Markets are not as rational, but eventually rationality takes place. So we will tell investors, if your five-year average multiple is 35 times, so price to earnings, work with 25 times as your exit multiple. Prepare with that margin of safety. So in other words, what we will tell them is, in play for earnings growth offsetting the compression multiples. Okay. Now this takes us to another point, which is, why should earn valuations in the multiples come down, right? So our call is terminal values. We need to recalibrate them vis-a-vis the last 5 years, when half the world's bonds were in negative yield trajectory, or the extent of low interest rate regime, if that's going to change now. We need to brace ourselves for lower multiples, higher earnings. So in other words, we need to bet on growth coming, or look at companies whose earnings growth can offset the shrinking or likely lower multiples, and still I can make healthy stock returns if I hold the stock for anything beyond 18 to 24 to 36 months. That's the point we'll want to advise.
So then, therefore, I have last couple of questions. One of them is on, tell us the themes which fall in this bracket that you're talking about. And then I have a follow-up question on themes wherein wherein you don't take this caution into account, but where you believe the combination, the potent combination that you spoke about of operating leverage or price hikes combined with operating leverage uh, will be the most seen, everything else remaining constant. So
Yeah.
first, let's talk about where you are cushioning or wanting to cushion for that fall in multiples, but still believe that there could be uh, visible uh, growth in returns. Which are those themes?
It comes to pricing power primarily. We are going to talk pricing power as possibly the most important buzzword over the next 12, 18 months. Which company? So it's going to be a polarized market, is our call. It's not going to be like last 12 months where actually every sector did well. Okay, we think it will be company specific, sector specific. Cyclicals are our lean clearly tilt towards where, as I said, the earnings growth trajectory can surprise and offset the multiples contraction. So we are focusing more on near term cash flows growth for companies which can offset any potential risk of lower multiples. So our portfolio is overweight on banks, overweight on discretionary consumption, autos included as part of it. Uh, Industrials which are focused on either household capital expenditure or on government capital expenditure. We have been positive on pharma now for more than 2 years. For it was heavily pushed back a couple of years back. It became the best performing sector in 20, but we still remain positive on pharma. Very company specific, not a sector view, but specific companies we really like in that space. Where are you underweight on? We are underweight on life insurance. We are underweight on staples and IT, and also a bit of oil and gas names, and also some of these private sector capex proxies. We still think our best bets are in household capex and in government capex. Corporate capex, seeing the capacity utilizations, we still think it's still some time away, and we'll want some more margin of safety in those stocks. Mm, broader points are what we are looking at. Cyclical recovery aiding pricing power in the sectors that we think are best positioned, which are in industrials and discretionary consumption. That's where our broader pockets of comfort are. Financials is more broader recovery, return on assets expansion. So we think the banks, when you look at the how the last few years have played out for banks, they've had a lot of credit costs, or in our assessment, over provisioning has happened, which has moderated return on assets. Banks have offset it by capitalizing heavily, so that has moderated return on equity. So the reported return on assets and return on equity are well below their base case expectations. So our expectation is we should see an improvement in both, and as a result, how we value them needs to be seen in terms of the fact that many banks could actually report a doubling of a return on equity over the next 18 to 24 months. In that context, we also we our biggest overweight stance is on banks.
Doubling of ROEs. Wow, that's a tall call. Is it? I mean, then therefore, is that universe comprised of banks which saw some bit of ROE decimation in the preceding 12 months, or you reckon ones which held out on their ROEs could still double because of the cycle?
Right, a combination of both. No, it's not just last 12 months. It's actually even the preceding 3 years, actually. So a bunch of banks were reporting very high levels of credit costs in fiscal 18, 19, 20. In fact, maybe even in fiscal 16, actually. Okay, maybe fiscal 17 onwards. Their credit costs were just too high, and it continued during the pandemic period as well, when banks created these excess COVID provisions. So our call is provisioning in excess of 70%. Banks with provisioning coverage in excess of 70%, who are sitting on double-digit tier one capital adequacy, they are best positioned to report better return on assets and better return on equity going forward. That's where we think are some of those banks. I mean, it's not every bank clearly, but there are if you do the understanding of the managements right, there are a few pockets of positive strength which we see coming there.
Oh, that's interesting. Um, um, you mentioned you are overweight autos, and in Ganeshram, the point is, even if I assume that some of the auto companies have pricing power, we have to take into cognizance the fact that they have been forced to hike prices because of the uptick in commodity costs. And from what we hear, that steel contracts with auto companies, even in the current quarter, or not, or rather in the upcoming quarter, which is April to June, could get renegotiated further. So as much as there might be pricing power, there is serious raw material cost inflation. Would that not hurt them?
See, in our minds as investors or as market, we focus on margins. Um, Managements always focus on market share. Okay, so there is always a dichotomy in terms of expectations of investors vis-a-vis managements. Management's priority is always protect market share. Eventually margins will take care of itself, and especially in the consolidating sectors, like especially passenger cars, I told you, look at the number of companies. We think about 15% of the total market is giving up market share, and three players are gaining it. Why will auto companies want to give even an iota of chance for some of the weaker players to come back? So protecting market share will be the primary focus, or at least the shorter term focus. We think that will eventually pay off as margins improvement, gradual pricing power. No management will want to shock the customer by announcing a 10% price hike one shot. They will calibrate it over 4 quarters, and which is good. I mean, we are absolutely fine with a calibrated price hike mechanism. In the meanwhile, if that leads to margin pressure, that's fine, because you see the end story, how this can eventually play out. We are comfortable with how that will eventually take shape, because I'm not just playing next quarter earnings and extrapolating it and try to make a quick buck. That's really not the way we are recommending clients. We think the broader story of how this will play out means autos will be an inherent part of our recommended set of stocks, and cyclically, and how some of these managements have prepared for better tomorrow during the lockdown. During even the previous year, fiscal 20 was actually a worse year for auto stocks in the lead up to BS6 implementation. They actually had a tougher time than actually in the pandemic. So now with 2 years of challenges, they are coming off that with in far better shape.
Okay. My final question, Ganesh. I mean, I was going to ask you about IT, but you've told me that you're underweight IT. So we'll leave that out. Not a problem. I want to end this conversation by asking you, where is it that you are most bullish on within newer themes that are taking shape and form, right? So one, because of the PLI benefits, a lot of newer, how do I say it, sectors are kind of getting formed, right? Mobile manufacturing, for example, etc. We were speaking to, I think, Praj Industries the other day, and they were talking about how bio CNG is turning out to be a really huge opportunity, some 1.75 lakh crores or 2 lakh crores manufacturing necessities, and the government has rolled out the program as we speak. Ethanol is turning out to be such a big thing because of the 20% mandatory deadline being brought forward. Then the government is doing a bunch of other things, including on the CGD part and setting up more lines. So it's an established sector, but it's taking newer shape and wings and form. And solar energy, for example, with the whole ESG theme. So within these newer things that have taken shape and form, say in the last couple of years at best, where is it that you are the most optimistic on?
PLI. Okay. The most biggest thing we see playing out is outsourced manufacturing, and our assessment is we will see a lot more. And here we are not talking of just export potential. We are talking of companies who are currently manufacturing in India, catering to domestic markets, wanting to focus on more on the marketing side, sales side, and leave the manufacturing to a specialist. So outsourced manufacturing will happen in our assessment across multiple baskets. Of course, a big part is reducing the imports and eventually increasing exports. But that is actually not the only point we are focusing our attention on. We think manufacturing in general is possibly the biggest emerging theme of the last 24 months in our assessment, and and the multiplier of manufacturing into the economy is very high in terms of its impact on fiscal, and as a result how fiscal takes shape in terms of how the job creation happened. So it's manufacturing and industrials, as I said, where we are overweight on. We think that's the biggest theme where we are preparing our next few years towards. Reflation, which is government spend globally, is also something that we are increasingly focusing our attention towards. The reason is we are coming after many years. See, monetary, if you look back in 2009 of the crisis, the problems were in the market. Okay, so central banks were drivers, and they put money into markets' hands, and that led to high multiples, lower earnings, or lower lower bond yields. But real economy didn't really show that improvement, so earnings were a little muted. Whereas now the problem is in the real economy. Now the problem, markets are fine. Okay, so the real economy is facing the heat, which means it's going to be fiscal led recovery, and a fiscal led recovery is going to be money being put into people's hands. It means real assets, it should be metals and property and mining, and of course we need to wait and watch. We don't know still, the real character of how this reflation will happen. It looks like it will be infrastructure spend led. If that is the path likely to be taken, yes. But if it's going to be more of money being put into people's bank accounts directly, and monies, then it's a different thing. It will be deleveraging, or it will go into more of digital spend. So the impact of reflation on the end segments and which stocks you really want to buy, it's not very clear still. We could assume, but that's why we are not recommending global cyclicals yet in our model portfolio. Ours is more domestic cyclical recovery led.
Okay, Ganeshram. Really appreciate. Sorry, I had a small internet connectivity issue in between, but I think we still got the gist of your conversation going. Really appreciate. And I think, Ganeshram, what we'll do is, this is 31st of March, closer to maybe mid-May, when the earnings season would have been done. I would love to extend that point of manufacturing and do a show with you only on how do you see manufacturing moving ahead over the course of the 24 months, and what components within that will do well. So we'll try and do a focused conversation then post earnings. Thanks so much for joining in today, Ganeshram.
Pleasure's mine, Neeraj. Always good speaking to you.
Likewise. And viewers, thanks for tuning in to this edition of The Talking Point.